Investors are weighing in on President Trump's historic new global tariffs.
You have the Dow, the Nasdaq, and the S&P all down below, as you can see there, 3%.
$5 trillion. That's how much vanished from the U.S. stock market in just 48 hours. The trigger? A single political move. President Trump's aggressive tariff policy. It's more than a number. It's a flashing red signal that America's economic stability is hanging by a thread. The U.S. dollar is weakening dramatically. Major indexes are plunging. And now, the world is turning its back on Washington's trade strategy. For context, that's more than the GDP of Japan. Investors panicked. The S&P 500 lost 600 points. The Dow Jones plunged nearly 4,000. And as the U.S. dollar weakened sharply, it became clear that this wasn't just another political maneuver. It was an economic earthquake. Trump's decision to impose a 25% tariff on Chinese goods and to extend similar penalties to other trading partners was framed as a bold move to protect American manufacturing. But the backlash has been swift and global. China responded by slapping 125% retaliatory tariffs on American exports ranging from cars and computers to agricultural equipment. In parallel, they accelerated their de-dollarization campaign, shifting oil and tech imports to be settled in yuan or gold. The European Union also pivoted quickly, forming new trade pacts with South America and Asia in a move to bypass U.S. dominance. This isn't the first time tariffs have sparked a market crisis, but it may be the most dangerous. In 2018, Trump imposed 25% steel and 10% aluminum tariffs. The Dow dropped 1,100 points over 3 days, but this time the damage is broader and deeper. We're witnessing a structural rift, not just a market correction. American allies, once bound by post-war institutions like NATO and NAFTA, are now openly seeking independence from Washington's economic orbit. Canada signed multi-billion-dollar energy and automotive deals with China. Mexico retaliated with sharp duties on U.S. corn, beef, and soybeans, the same exports that propped up rural American economies in past decades. Meanwhile, the global role of the U.S. dollar is visibly eroding. The euro has become a preferred safe haven, and the BRICS nations are fast-tracking alternative financial systems based on digital currencies and commodity-backed settlements. For the first time since the fall of Bretton Woods in 1971, oil contracts are being signed in yuan and rubles, not dollars. Washington's grip on international trade has never looked so fragile. When asked about the unfolding crisis, Trump appeared unfazed. On Truth Social, he posted, "Stay calm, everything will turn out fine. America will be bigger and better than ever before." But while the president projects confidence, the real numbers tell a different story. Inflation has surged to 5.2%, reaching post-2008 financial crisis levels. Unemployment now hovers at 4.2%, similar to pandemic-era job losses. Small businesses are closing. Foreign investors are dumping U.S. assets. The Japanese stock exchange halted trading altogether after a cascade of sell-offs. The markets aren't correcting, they're collapsing. Yet, instead of announcing a coordinated recovery plan, Trump was seen celebrating at a private gala, boasting about his new Tesla while guests flaunted $445,000 Birkin bags. Meanwhile, average Americans are being crushed by rising grocery and energy costs. It's a scene eerily reminiscent of the 1979 energy crisis under President Carter, when inflation and stagflation, crippled American households while confidence in Washington evaporated. Tesla, once the poster child of American innovation, has lost 45% of its sales in Europe. Canada has frozen $104 billion worth of oil exports to the U.S. The European Union has launched a $40 billion retaliatory tariff package. Even Trump-friendly media like Fox News are turning critical. Tariffs are not a tax cut, they're chaos, one segment declared bluntly. The Federal Reserve is now projecting a 65% likelihood of recession in the next fiscal year. Trump himself finally acknowledged economic trouble in a Fox Business interview, stating, "The economy is in a transition period." But what kind of transition? He provided no roadmap, no strategy, no coordination with Congress, and no reassurance to markets. Economists are beginning to draw comparisons to the infamous Smoot-Hawley Tariff Act of 1930, a protectionist policy that many historians argue deepened the Great Depression. Back then, over 25 nations retaliated. Trade collapsed. American exports fell by more than 60%. Unemployment reached 25%. Are we heading down that same path? What makes today even more precarious is the speed of global reaction. With digital trade platforms, and instant capital flows, global supply chains are far more integrated than in the 1930s. A disruption in U.S. trade policy now triggers ripple effects in minutes, not months. The fact that allies like Canada and Germany are openly preparing Plan B partnerships without U.S. participation speaks volumes. And don't take your eyes off the screen, because what's coming next could change everything.
Are we going to win the trade war with China? No, probably not.
The White House says the ball is in China's court when it comes to fixing the tariff war between Washington and Beijing.
iPhone prices in the United States could soon skyrocket, from $1,499 to a staggering $2,300. That's a 44% jump in just one product cycle. And this isn't wild speculation. It's the predictable result of a high-stakes game played not by regular Americans, but by a small group of elites in boardrooms and Washington backrooms. Just days ago, Apple made a stunning move. It airlifted 600 tons of iPhones, roughly 1.5 million devices, from India to the U.S. Why? To dodge the new 125% import tariffs slapped on electronics assembled in China. It's an emergency maneuver, no doubt expensive, but one Apple considers worthwhile. Because they won't be the ones paying for it. Airlifting that amount of cargo is estimated to cost over $35 million, nearly 10 times more than sea freight. You will. But don't take your eyes off the screen, because this is just the tip of the iceberg. In the latest chapter of America's economic counteroffensive against China, the U.S. government has escalated import taxes from 54% to a crushing 125% on electronics made in Chinese factories. On paper, this sounds like a bold move to bring jobs back home. In reality, it's a desperate gamble that forces companies like Apple to rewire their entire global supply chains and pushes the cost burden straight onto the American consumer. According to the Peterson Institute for International Economics, 92% of U.S. tariffs are ultimately paid by domestic businesses and consumers, not foreign exporters. Here's the catch. While Apple scrambles to shift assembly to India, early production at new factories suffers from inefficiencies, low yield rates, and massive capital costs. According to Bloomberg's Global Supply Index, setting up iPhone production in India could cost 12 to 18% more in the first year compared to China. And guess where that difference is going to be absorbed? Right again, your wallet. Meanwhile, the elites stay quiet. They want you to think this is tough on China. In reality, it's punishing American workers and consumers while the very same tech giants reroute operations overseas. Not back to Detroit, not to Ohio, but to Vietnam, India, and Mexico. The factories are still leaving China, but they're not coming home. We've lost control of the chessboard, and we're still clapping like we're winning. And while Apple may be the most visible player in this drama, they are far from alone. Other tech giants, Google, Dell, HP, are all accelerating similar exits from China, not to reshore, but to avoid tariffs. It's not a reshoring revolution. It's a supply chain shell game. The jobs don't come back. The prices go up. In fact, USES. Manufacturing job growth has stagnated since Q3 2023, with over 132,000 jobs lost through Q1 2025, according to the Bureau of Labor Statistics. And no one is being held accountable. In the financial markets, the shock was immediate. Within 48 hours of the tariff announcement, the Dow Jones plummeted over 1,700 points. Apple lost 5.6% of its market cap. Tesla, 4.8%. Investors aren't reacting to patriotism. They're responding to instability. And the Fed now warns the probability of a 2025 recession has risen to 65%, the highest since 2008. Core inflation has also crept back up to 5.2% year over year, despite aggressive rate hikes, driven in part by higher import prices. And what are average Americans left with? Higher costs, fewer options, no jobs returning. The tariff won't appear on your receipt, but you'll feel it every time you upgrade your phone, buy a laptop, or replace your refrigerator. The Consumer Electronics Association now estimates that the average American household will pay an additional $480 annually due to increased tech and appliance costs. Historically, this isn't the first time we've been down this path. In 1929, the infamous Smoot-Hawley Tariff Act imposed sweeping taxes on over 20,000 imports. The result? A global depression, mass unemployment, and trade retaliation that crippled our economy. Today's version is slicker, quieter, and better packaged. But the effect is no less devastating. And yet, no hearings, no outrage, no mainstream coverage. Because the truth is, both political parties have outsourced economic sovereignty to corporate interests. They wear the American flag, but sign deals offshore. They talk reindustrialization, but their portfolios grow from cheap labor and overseas tax shelters. In 2024 alone, S&P 500 companies repurchased over $925 billion in stock, money that could have gone into American plants, but instead enriched shareholders. Even Apple's shift to India isn't a patriotic decision, it's a hedge. India offers cheaper labor, looser regulations, and less political heat. But that transition comes at a cost. Entire factories must be built, workers must be trained, logistics re-engineered. In the short term, this adds up to hundreds of millions of dollars in transition costs, which are quietly passed down, device by device, to American consumers. And while Apple spends $5 billion building capacity in India, it has invested less than $500 million in domestic manufacturing over the same period. And if this is only the surface, just the price hikes, the stock dips, the supply chain headlines, then what lies beneath? It's about betrayal, and the reckoning is just beginning.
China's government has reportedly ordered its domestic airlines to stop accepting deliveries of Boeing jets.
The news coming out of China, there's a report that China has told its airlines.
The Chinese government has asked its carriers to stop taking delivery of Boeing aircraft in the meantime.
In a shocking turn of events, China has decided to put a hold on all new orders of Boeing aircraft, stopping deliveries dead in their tracks. This unprecedented move strikes a devastating blow to the already strained U.S.-China trade relations. In a retaliatory approach that echoes loudly, China has also suspended the purchase of all American aircraft parts and crucial components, leaving the aviation industry and governments alike in spiraling turmoil. Is this another nail in the coffin for you? As a China relations, or can diplomacy save the day? As the conflict deepens, neither side is cooling down. U.S. President Donald Trump recently ratcheted up the economic tension by imposing tariffs as high as 145% on Chinese imports. Not to be outdone, China swiftly retaliated, hiking tariffs on American goods from 84% to a striking 125%, with some tariffs mirroring U.S. rates at a brutal 145%. These measures raised the stakes dramatically, making it financially insurmountable for Chinese airlines to sustain their Boeing aircraft purchases. The latest twist feels like a full-blown retaliation cycle, says a frustrated airline executive. With Boeing scheduled to ship roughly 10 737 MAX aircraft to China, involving major carriers like China Southern Airlines and Air China, the order's future hangs in suspense. It's unclear if any jets will make it to the runway this year. Let's dive deeper into this brewing storm. Data paints a picture of enormous opportunities going awry. Boeing, a cornerstone of the American aerospace industry, delivered 130 jets globally in Q1 of 2025, with 9 Chinese airlines receiving 18 planes. Among the looming deliveries, Air China was set for a bounty of 45 planes by 2027, China Eastern with 53, and China Southern primed for 81. Analysts predicted Chinese airlines could order up to 29 Boeing jets this calendar year alone, a significant chunk of the global market share. China represents a whopping 20% of the world's large civil jet demand over 2 decades. And yet, President Trump couldn't contain his dismay, expressing in a Truth Social post, China just reneged on the big Boeing deal, saying that they will not take possession of what were supposed to be fully committed orders. As Beijing halts U.S. aircraft acquisitions, broader implications unfold. The no-purchase order encompasses all U.S. origin aviation equipment, components, and maintenance services. Industry observers forecast skyrocketing maintenance costs for existing fleets, stressing China's aviation market. Indigenous manufacturer Comac surfaces as a potential alternative supplier, yet neither it nor European rival Airbus can fully bridge the gap, Ronald J. Epstein of Bank of America offers some reassurance, suggesting Boeing should have no difficulty reallocating the aircraft, with India possibly becoming a recipient market should the delivery block endure long-term. What does this mean for industries on both continents? China's drastic measures are sure to elevate maintenance costs, burdening domestic carriers with financial strain. While the Chinese government reportedly eyes potential subsidies and relief options for affected airline operators, Boeing faces immediate short-term repercussions, evidenced by a notable slump in shares, a decline ranging from 1.6% to 3.72% depending on market reports. In the longer term, Boeing may leverage other markets to mitigate these losses, yet the question remains, how sustainable is this impasse? The ramifications in geopolitical terms are just as profound. Are we witnessing the fever pitch of a trade war that originated during Trump's earlier term, targeting an array of sectors from high-tech to metals? This enduring struggle now finds its focus on aviation, stranding negotiations in a deadlock. No comment has been issued as of the morning of April 16, 2025, by either Beijing or Chicago-based Boeing about any potential shifts or future dialogues. Can skies clear over strained trade policies? Right now, is diplomacy the absolute last hope standing between escalated conflict and resolution? What are your thoughts on this developing crisis? Will Boeing manage to pivot to alternative markets, or is the company facing unprecedented challenges ahead?
China needs to make a deal with us. We don't have to make a deal with them.
Washington confirming taxes of up to 145% on Beijing, which has responded with 84% tariffs of its own.
Today, we're diving into a heated clash shaking up global trade. China has fired back at U.S. President Donald Trump, calling his latest tariff plans shameless and warning they'll backfire spectacularly. But what does this mean for the U.S., China, and the rest of the world? Are we headed for an economic showdown, or is this just political theater? Let's break it all down. First, let's set the stage. Just days ago, President Trump announced a sweeping new round of tariffs targeting Chinese goods, everything from electronics to clothing and even critical raw materials. The plan? Slap hefty taxes, some as high as 25% or more on billions of dollars worth of imports. Trump says it's all about protecting American workers, bringing manufacturing back to the U.S., and countering what he calls China's unfair trade practices. Sound familiar? It's a playbook straight out of his first term, but this time, the stakes feel higher. China didn't waste time responding. In a sharply worded statement, Beijing's Ministry of Commerce labeled the tariffs shameless and accused the U.S. of bullying its way through global trade. They warned these moves could disrupt supply chains, hurt consumers worldwide, and here's the kicker, backfire on the U.S. economy itself. But why is China so fired up? And what's really at risk here? The tariff plan. What's happening? So, what exactly are these tariffs? In simple terms, a tariff is a tax the U.S. government puts on goods coming from another country, in this case, China. Trump's latest proposal targets over $500 billion in Chinese imports. That's a massive chunk of the $700 billion in goods the U.S. buys from China every year. Key sectors? Think smartphones, car parts, toys, and even medical equipment. The goal, Trump says, is to make Chinese products more expensive so American-made goods can compete. Trump's argument is straightforward. He says China's been flooding the U.S. with cheap goods, undercutting American businesses and costing jobs. He also points to national security, claiming reliance on Chinese tech, like semiconductors, puts the U.S. at risk. Supporters love this tough stance, seeing it as a way to revive industries hollowed out by globalization. But here's where it gets tricky. Tariffs don't just hit China, they ripple. American companies importing these goods face higher costs, which often get passed to you, the consumer. That $200 phone, it might cost $250. That new car, add a few grand. Critics, including some U.S. economists, warn this could fuel inflation, already a sore spot for many households. China's response? Why so angry? Now, let's talk about China's side. Beijing's not just upset, they're livid. Calling the tariffs shameless is diplomatic speak for "this is outrageous." Why the strong words? For one, China's economy relies heavily on exports to the U.S., $500 billion worth last year alone. Tariffs threaten that cash flow, hitting manufacturers and workers hard. But it's not just about money. China sees this as a power play. They argue the U.S. is trying to kneecap their rise as a global superpower. In their view, these tariffs violate free trade principles and could destabilize the World Trade Organization, which sets global rules. They've even hinted at retaliation. Think tariffs on American goods like soybeans, cars, or even tech from companies like Apple. And China's not bluffing. During Trump's first term, they hit back with tariffs on U.S. agricultural products, crushing farmers in states like Iowa and Nebraska. Could we see round two? Possibly. But China's also playing a longer game, strengthening trade ties with Europe, Africa, and Asia to reduce reliance on the U.S. market. Will it backfire? The risks for both sides. So, here's the million-dollar question. Will Trump's tariff war backfire, like China claims? Let's look at the U.S. first. Economists are divided. Some say tariffs could boost domestic manufacturing. Think steel plants reopening or new factories for electric vehicles. But others warn the costs outweigh the benefits. A 2024 study by the Peterson Institute estimated similar tariffs could raise U.S. consumer prices by 2 to 3%, hitting low-income families hardest. And it's not just prices. U.S. companies like Walmart or Tesla, which rely on Chinese parts, could see profits shrink. Small businesses importing goods, they might get crushed. Then there's the global angle. Disrupted supply chains could delay everything from holiday gifts to hospital supplies. Now, China's not immune either. Their economy's already grappling with a property crisis and slowing growth. Tariffs could shave billions off their GDP, forcing layoffs or factory closures. But China's got tools to fight back, devaluing their currency to make exports cheaper or doubling down on domestic tech like Huawei to replace U.S. imports. Still, retaliation risks escalation. If China slaps tariffs on U.S. goods, American farmers and manufacturers could take a hit. And if both sides dig in, we're looking at a full-blown trade war. Bad news for a global economy still shaky from inflation and geopolitical tensions. So, where does this leave us? The U.S. and China aren't just trading goods, they're trading blows in a fight for economic dominance. But the fallout won't stay contained. Europe's already nervous, with leaders urging de-escalation. Developing nations reliant on trade, like Vietnam or Mexico, could get caught in the crossfire. Even you, watching at home, might feel the pinch at the checkout line. Trump's betting that short-term pain will lead to long-term gain for America. China's banking on resilience and global alliances to weather the storm. Who's right? That depends on how far each side's willing to go and whether cooler heads prevail. And that's the story so far, a tariff war heating up with no clear winner in sight. But we want to hear from you. Will Trump's tariffs save American jobs or tank the economy? Is China's retaliation a bluff or a game changer?